All right. Good afternoon, everyone. This is Rich Swerbinski with the Mortgage Collaborative here with the last week in Mortgage Today, our weekly walk through all the latest happenings in the wild and wacky mortgage industry. And each week, I am pleased to be joined by one of our lender members as my co-host. And this week, thrilled to be joined by the VP Mortgage Lending for Truliant Federal Credit Union out of North Carolina, Beth Eller. Beth, thanks for joining me.
Thank you so much. Glad to be here.
Awesome. So let's jump right into it. And let's start with news that just came out today. The Case-Shiller Home Price Index, kind of the national standard on home values. Home values up 14.6% year over year. This is April 2021 versus April 2020. Each month, home values continue to appreciate. No real sign of any end to it, with still a lot of demand for people to buy homes and certainly some supply side issues. Your thoughts as just a leader in the industry when you see these home price appreciation reports come out?
Well, certainly it's a great time to be a seller. We can all appreciate that. And inventory continues, I think, to drive these numbers to a large extent. And with the price ramp up on construction materials, the lack of new construction in the market, it just continues to be a really difficult time to find a home as a buyer. Do have concerns about the price affordability, especially those entry point level buyers that typically are what moves the market upward.
And of note in the report, there was a few cities that saw record year over year home price increases. One of them was Charlotte, where I know you guys do some business. It's obviously a hot market right now, right?
It really is. I think there's about a 1.2, 1.3 month supply of homes on the market in North Carolina, Charlotte being part of that. And my friends in the real estate industry that I talk to say it's really more like 3 to 4 days for most homes on the market, and they're snatched up. So just no inventory to speak of.
Some other items to note in the report, there were the three major metropolitan cities that saw the largest price increases: Phoenix, Seattle, and San Diego. Three Western Coast cities, but price increases throughout the country. Of note, the last month's numbers, March, was 13.3% increase year over year. Now in April, 14.6 increase year over year. So numbers keep trending up in terms of home values. And like you said, good time to be a seller. I unfortunately just bought a home, so I don't know how good my timing is, but interesting there. So this is the last week in Mortgage Today. I'm with the VP Mortgage Lending for Truliant Federal Credit Union, Beth Eller. And as always, just a reminder, strive for interactivity in the program. Any questions, comments, thoughts, anything, please feel free to drop it into the chat or the Q&A, and we'll incorporate it into the show. But let's move on to the interest rate market. A little relief today, it looked like, but in general, 30-year fixed rates have been trending up. Right. I think they're at the highest levels since April. It's all relative. 30-year fixed rates are about 3%. Right. So it's not like, we're talking about the early 70s here. So, but just wanted to get your sense. There's a lot of, I think, sentiment coming into the marketplace right now. The last Fed meeting, after the testimony, some of the Fed members were really grilled by Senate Banking Committee members about why they keep pumping so much money into the mortgage bond market, asking them if that's a wise allocation of, Fed gunpowder, that the housing market's already on fire and they're kind of just gassing it. So there's this sentiment creeping into the marketplace that maybe the Fed will start to take their foot off the gas pedal. That coupled with an improving economy, still some signs of inflation permeating through the marketplace, that we could finally, maybe this could be the end of 30-year fixed rates in the twos, and we could get what economists have been predicting seemingly for 2 decades, and the slow incline to from 3% to 4% 30-year fixed. Your thoughts on the current interest rate climate?
Well, I think it's going to be interesting to see how the Fed does continue to react to that, if they'll continue to pump money into mortgage backs or look more on treasuries and see where they go with that. And they've been purchasing at a clip of about 40 billion each per month, so about 80 billion. And I think the real impetus to continue to do that is if they stop, granted it might cool this hot market down, but that would give us a much bigger, quicker swing in rates. The whole point of their purchasing those mortgage backs is to keep these longer term rates low. And so I think they've got to be really careful. Most of us can see that while the economy does appear to be improving, everywhere you go, we all see, I don't care what part of the country you're in, help wanted signs everywhere. Businesses are trying to hire people to come back to work. And until you get a more stable economy, it's kind of a tough place for the Fed to do much to disrupt that at this point, I think.
Yeah, very valid points. And like when the Fed has been getting asked these questions with increasing regularity after their meetings, and I think what Jay Powell doesn't say, but you could see him thinking is there's a lot of benefit to what we're doing. You already have an affordability issue with home values going up. The bottom end of the market, it's way tougher to buy a home. Mm-hmm. So if us manually kind of maneuvering interest rates lower is really helping affordability on the margins. And also just think of all the people that refinanced because 30-year fixed rates were in the low to mid twos that otherwise would not have. The amount of money that saves them monthly, pumping that money back into the economy in different ways. So all in all, it seems like the Fed has done a pretty good job maneuvering through the pandemic. Would you agree?
I would agree. I think so. There are only so many fulcrums or levers that they can pull, and I think they've been pretty wise in how they've approached it at this point. And that lower entry point to the market is, as you and I were discussing, Rich, you do worry about the affordability of homes and what that does to that entry level place. But if the rest of the market has interest rates so high, if interest rates are so high, the rest of the market can't afford to buy houses, it doesn't help those entry level buyers anyway.
Yeah, absolutely. Moving on, Fannie and Freddie changes afoot. And, we've been talking on this show about, the PSPA amendments and the non-owner occupied caps and a lot of negative, at least for our industry and putting people in homes and making loans, things, the news broke last week that the Biden administration, through a Supreme Court ruling, would be able to relieve the CFPB FHFA acting director of his duties. They immediately did that. I guess he actually resigned, but really just minutia. And now a lot of different type of discussion around Fannie and Freddie. I know our members in general, I think separate from how much you feel about should the government be in mortgage lending? Are you a big government or a small government person? Right now, with everything going on, it seemed like some of the things happening with the agencies didn't make a lot of sense and weren't communicated at all to other counterparties in the industry. The stock market, like the Calabria firing, all the publicly traded mortgage companies rallied on that news. And the White House immediately appointed an interim acting director of the FHFA, Sandra Thompson, who's been the deputy director of the FHFA's Division of Housing Mission Goals. So an experienced person. And, in just listening to one of the MBA town hall calls from a couple weeks ago, Bob Brokesmith from MBA mentioned that Sandra Thompson, that the interim appointment would be months and not years. They would immediately look to appoint someone. So your thoughts, just as somebody running a mortgage division for a credit union, on all the transgressions we've seen with Fannie and Freddie and what could be lying ahead in the future.
It's a great topic of discussion right now in the industry, and couldn't be more contrasting in where Calabria was with the previous administration and where Biden is as far as home ownership and Fannie Mae and Freddie Mac and FHFA's guidance and direction. We know we're now going to see a real emphasis on first-time home buyers, potentially tax credits. How does that work? The duty to serve that they have been under will continue for sure. The whole talk about privatization of those two entities, I think, is kind of at the heart of this change in the administration. I would imagine under Biden's guidance, you're not going to see a push to privatize Fannie Mae and Freddie Mac and Fannie Mae. It'll be more of the same GSE type of work atmosphere that they've been under all this time. And I think that's one of the things the market has struggled with, Rich, is how would you ever unwind that big machine and figure out what it could look like? And so I think that's one of the reasons the market responded favorably to that. And then you will see a real push towards home ownership from this administration. I think that's been clear with their interim appointment as well.
Yeah, they've already started to make a lot of appointments and nominations for appointees. We'll get more into that in a second here, but this is clearly going to be an administration that is going to be fighting hard for people, on the lower end of the home buying spectrum, first-time home buyers. It's a very difficult climate, as you've chronicled throughout the beginning of this show, in many ways for that group of potential home buyers. And I just think the pressure is going to continue to mount.
Yes.
Interest rates really can't go down. I guess maybe a little, I've said that before and been wrong, but values are going to continue to go up on all ends of the spectrum of homes, because we don't have new inventory coming to the market, at least to the degree that it satiates the demand. So I think the pressure is going to continue to mount. And you're going to see probably some things that may seem shocking to people, from the Biden administration through Fannie and Freddie, that are very pro-housing, pro-first-time home buyer.
I really think you will as well. If you look at, I know we participate with the Federal Home Loan Bank out of Atlanta and their set aside down payment assistance program, and they were out of funds by April of this year. Normally, they have funds through until the end of the year. So you've seen a real emergence in those down payment assistance programs being utilized by lenders in ways they had not in the past, really doing everything they can to help people get into homes. And so you're going to see more of those types of programs. You're going to see Fannie and Freddie really expand, I think, into that first-time home buyer space in ways that they have not in the past. They're new affordable, both of them with their refinance programs they've come out with, as an example of that for borrowers that we normally wouldn't look at a 65 DTI and say, yeah, let's refinance that loan. But we're going to be looking at things that we're unaccustomed to, I think, as the economy continues to recover. And I agree totally with your point. There's nothing that's going to press downward on these housing values in the immediate future, and probably not for several years. I don't know that I think that it's a bubble. I've been asked that, and it doesn't feel like a bubble because there's nothing to push it back down.
Absolutely. And I see my friend Rob Krisman in the audience. He's been leaking out, things he's been hearing from his spies in the industry, in his newsletter, some very interesting things, some things that are more obvious. First-time home buyer tax credit was something that was part of President Biden's campaign and his formal housing stance. But one thing I saw that he put in his newsletter was very interesting, and I could see this happening, and it's one of those things that may seem surprising and shocking to those of us that have been in the industry for a long time, but the loan level price adjustments with Fannie and Freddie that we've all grown to know and just get used to, right? If you're 719 FICO and 91% loan to value, you have, I don't know exactly what they are anymore. It used to be burned into my brain, but and then, if you're 40% down and an 800 FICO, there's no delivery fee or a minimal one, flattening that out completely.
I saw that.
Kind of like they do with FHA, where everybody pays the same insurance premium. So that's something I think you could see happening to, as the Biden administration has said with regards to housing, level the playing field.
And I think that would be really interesting to see that, come into fruition. I just saw Rob popped up to do the rich plan, and what was that? Rob take away all the tax credit to the seller as well. But I think that there's a lot of room out there for things like this. If you did away with loan level price adjustments in tiering and you flatten that out, then the affordability of the mortgage loan itself becomes a whole lot easier for a lot of people. If you think about what that could look like across types of housing, not just credit scores, but loan to values, all of those factors that impact rates today, it could make it much more attractive.
And Rob, you are unmuted if you want to jump in on this, but he's posting about the Swerbinsky plan. I had mentioned on the rundown, should I do it, Rob? Tax break for people that sell homes. And that are owner non-institutional investors as a way to put more inventory out there and encourage people to sell their homes and help with all these issues. So that's something I think you could see on the table as well.
I think so too. And Rob is generally very intuitive about the housing market. We certainly all appreciate his thoughts and commentary on that. I've followed you for years, Rob. And
so can you guys hear me?
We can.
The voice from above. So Beth, hats off to you. I'm sitting here in rapt attention, listening to what you're saying about the business and what you're seeing. I think it's very, very valuable.
Thank you.
And anything I could add would pale in comparison. But that said, I do wholeheartedly agree that with the change in administration and the change with the FHFA and so forth, I think the Biden administration will be much more open to some industry input. I should say the FHFA will be more open to industry input, unlike under Mark Calabria, which I'd heard he wasn't very open to chatting with industry leaders in the MBA. I think Sandra will be much more open to that, and that's a good thing. So some creative things might very well come out of it, and I think the industry is looking forward to that.
It could be a great thing for the industry. I mean, think about it. We're coming off a $4.8 trillion record year for the industry. Most people were projecting 4.1, 4.2, another historically dominant and very busy year for the industry. And I think that you're going to see some things that really are going to help negate some of the headwinds to values and home buying for first-time home buyers from the Biden administration, with all the roadblocks out of the way now. So could be a really super strong year for the second half, but interesting to see how this all plays out. So along those lines, some appointments just to touch on, not much, I don't think, commentary needed here, but the Biden administration nominated Julia Gordon to be the FHA commissioner. She's currently the president of the National Community Stabilization Trust, an industry veteran. I don't know much about her. Beth, you know anything about Julia Gordon?
Not a lot. It's going to be interesting to see, what she does. Certainly has a great resume, but it'll be interesting to see her footprint or her fingerprints on that as she gets into that role. I think that it'll be a fundamental switch from a more conservative view of the agency to one that is more geared towards, especially the first-time home buyer market and what they can do with that.
And Rob, if you have any intel on any of these candidates, would welcome it. Sandra Thompson, we know, was appointed as the interim director of the FHFA. We're expecting a formal nomination of for a full-time FHFA director soon, most likely. That will be a vital, you start to talk about Fannie and Freddie as the vehicles for a lot of this potential change. The new FHFA director will be vital. We have Rohit Chopra, who was nominated to be the CFPB director. That is still hung up in Congress. And then I think it was just yesterday or today, the interim CFPB director, David Uiho, was nominated to be the Assistant Secretary of HUD. So some names really starting to come in place now for the Biden administration as they look to really formally pursue their housing agenda here in America. So
I think it's going to be a total change in the agenda from where we have been. If you look at Biden, like you said, that was a big part of his campaign. And I think you're starting to see a big emphasis put on that pretty early on in his presidency, and we'll need it. The refinance wave that we see now is, as we all know, they come to an end, and we're going to need something that's going to help propel this housing market forward. As hot as it is, that's one issue. No inventory is another issue, but at some point there is going to be a time when we've got to figure out how to get first-time home buyers in particular into houses.
Very well put. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by the Vice President of Mortgage Lending for Truliant Federal Credit Union out of North Carolina, Beth Eller. Beth, let's move our attention. Truliant Federal Credit Union, really a trailblazer in the e-close space. Our members in general, like I joke all the time about it in this program, like how the hell do we not have e-closes yet in 2021? It's insane. You can digitally sign for anything. Yet the vast majority of TMC members are still doing in-person wet ink closings. Some are doing some hybrids.
Yep.
But it's just insane to me that this is not here. You guys do a lot of business in North Carolina.
Yep.
Some of the other states you do business in support full e-closes. So as somebody that's like on the other side of the fence where all other mortgage lenders want to be, would love to just hear your perspective, because you've been doing it now for a while, on just, how customers adopted it, and just the roadmap that it took you to get there. So
it's been a great ride to get here. We did our first e-closing on March 26th, 2020. About 5 months after I arrived at Truliant, that was one of the things that we really wanted to do. And our Secretary of State here, Elaine Marshall, has really pushed e-commerce in the state of North Carolina. And our operations manager, Cindy Pearson, and Jennifer Hallowell had done a lot of work on e-closings prior to my getting here. And I had been at North State, which did the first e-closing in North Carolina, really the first one in the country, full e-closing. And so we wanted to be the first credit union based out of North Carolina to perform an e-closing. And once we started that, Rich, to be honest with you, we just wanted to stay in the full e-space. We didn't jump into the hybrid end of the space. We wanted to stay and push that fully electronic note. And it is easier, I think, in North Carolina than in some states due to legislation. But for people that are interested in it, you just need to lay out a roadmap of how to get there. It took us about 6 months to do a full e-closing. Once you do a few of them, it's like anything else. They're pretty easy once you get your head around it. We had a great partner with Doc Magic to provide our e-note for us and our e-vault. You get those things lined up, and the GSEs, Fannie and Freddie, are wide open as far as help. They'll do everything they can to help you get approved to do that. And we also worked with the Federal Home Loan Bank to do one through them as well. And so, or to securitize a loan through them. But it is a great experience for our members, for our borrowers. We have been able in the COVID world to not have to go into attorneys' offices. The attorneys, North Carolina is an ad attorney state, so attorneys are still present. It's a Zoom meeting, just like what you have today. And the attorney is there. You have the e-notary present. The borrowers sign the docs. We send them, much like a lot of people do with hybrids, we send them all the other docs ahead of time so they can review them. So the closing itself takes about 10 or 15 minutes. It can be done remotely at any place that the member or the borrower chooses. And that's been a great benefit. I think the speed and efficiency too, that you pick up on the backside, people ask me about the operational advantage that we've gotten from that. It's an instantaneous delivery. So the post-closing piece becomes really, really slick and smooth. They cannot progress in the e-closing if they miss a signature or signing place in the documents. And so you don't have to go back and get corrections. It eliminates a whole lot of those issues that we've dealt with for a long time that have really slowed down the backside operationally. So we love the e-space and really look forward to doing a lot more of them. And I think the industry's come a long way. It's funny, our LOS provider, we migrated onto a new LS provider at the end of 2019. And I kept saying, hey, can y'all do e-closings? And they were like, nah, that's 2-3 years away. We're not interested in that right now. We're not there, can't do that. And imagine COVID's impact on that, as we've seen as an industry now. Everybody wants to do electronic closings. So, and the consumer demands it. To your point, you can e-sign for anything today. So why not a mortgage as well?
Yeah, it seems kind of crazy to me that we're not there yet. And then, like when the pandemic hit last year, a lot of people were saying last spring, like, okay, one of the good things about the pandemic is by the end of 2020, everything will just get fast tracked through Congress. But still, not in at least 20 states, if not more.
I know, exactly.
There are still challenges. So it does appear like there is momentum the rest of this year and in the next year, where hopefully a lot of those roadblocks will come down. We haven't even formally asked you this yet, but we're going to do a big session at our summer conference in
Right.
Terranea, we're going to ask you and a couple other members of ours that have been full e-closings for some time now to lay out essentially what you just did verbally, all the different advantages and maybe some things you would have done different on the road there, and what you've seen just from customer experience and some other efficiencies post-closing and so on and so forth. So
We're glad to share.
Yeah, more to come on that, and we'd love to help you lead that session, and a good chance for me to make a plug for our conference, which is September 19 to 21 at just this posh resort just outside Los Angeles called Terranea. Very beautiful. And we've already got well over 200 people registered. Normally we'd be like opening registration right about now. So we're expecting by far our biggest event, and all the information you can want on that is available at mortgagecollaborative.com. So
it certainly looks like a great conference. I know that it's going to be top notch with TMS doing it.
Yeah, and we just posted the agenda. Like there might be some minor tweaks, but is up on our website, and thus you can see just the scope, the brevity of what we do. All these sessions lender-led by brilliant people like Beth that are subject matter experts in the topics that we're facilitating discussions on. So, Beth, the competitive climate. There was a report that came out a couple of weeks ago, independent mortgage banks, the most recent HMDA data, all the way up to 68% market share. Now that is fueled to some degree by like the Rockets and the Loan Depots and some of these giant guys that have just, gone crazy and gotten a lot bigger. Credit union market share, I think, stayed pretty consistent year over year. As somebody that runs lending for a credit union, would welcome just your assessment of the current competitive climate, depositories, independent mortgage banks. It seems like as we go forward into the future that, if it's, just what a construction lending and that non-vanilla, like saleable to anybody products will make a bigger piece of the pie. I know some of our depository members welcome that just from a competitive standpoint, but I'd be interested in hearing your thoughts on the competitive climate in the mortgage industry as we get into the second half of 2021.
It is an extremely competitive market, and you have to, give kudos to those big independents. They certainly have revolutionized the way that a lot of lenders look at mortgage lending and benefit to the consumer. We can all look at Rocket Mortgage and go, yeah, I wish I'd thought of that. It's a great marketing tool for them. And I think from a credit union perspective, I spent most of my career in the banking side and at Independence as well. And in moving to the credit union world, most credit unions are kind of filling that void that was created with all the community banks that have merged in the last 10 years. And so you have a community-based feel with a credit union, which you need that kind of stability. And I've thought about kind of different topic, Rick, but same thing, with the GSEs coming out under their agreement with the Treasury Department and the limits on non-owner occupied properties, second homes and investment properties and selling those them. If you have a portfolio, you still have the ability to do those things, or the construction lending product you mentioned, or we have 100% products for first-time home buyers. We have limited credit products, those proprietary products of things, doctor programs, CRA-related programs that you can put in your portfolio. There will always be a need for that out in the market. And I think the challenge for financial institutions is to figure out how to do quicker, better service, speed, efficiency, and move nimbly, because that's what we see independents be able to do. And I admire and respect them for that. The mortgage industry needed an overhaul. We've, I think, been so burdened by regulation. We all feel like we're overregulated, and I would be one that's in that camp. And how to figure out how to just get back to the basics of let's make a loan. What do we need to do to make loans, and who do we need to go out and solicit those loans from? Who's selling houses? How do you work with them? How do you network? Independents have just absolutely gone a different direction than the industry had been in a long time, and they're getting the fruits of their labor, in my opinion, with that. So, but I think in the financial institution space, there is plenty of room there for financials to continue to be successful, not only with those proprietary products, but in gaining speed and efficiency in what they deliver and how they deliver it in order to be competitive. It is a very interesting competitive market. And I think the second half of the year, it's going to be even more so that way as refinances start to really wane and you get into a purchase market. Then, that's when you really see where the rubber meets the road. Wouldn't we all love to be at a place where we had 60 to 70% purchase volume and 30% refinance volume? And I think most people were at the flip of that if you were a financial last year. And that's a scary spot to be. So I'd like to see that part of the market really start to heat up. And we enjoy the competition. We like that.
Beth, really enjoyed the conversation and really enjoyed hearing your perspective on the industry. Thank you so much. And you're getting the repeat invite to come back to the co-pilot seat for this show. So
Anytime, my pleasure. Thank you very much.
And to our attendees, thank you very much for spending 30 minutes of your Tuesday with us. We're here every Tuesday at 2 p.m. Eastern for the last week in Mortgage Today. And of course, we always upload these sessions to our YouTube page and release them as podcasts through Apple and Spotify, where I know a lot of people listen and watch as well. So until next Tuesday, have a great week, everyone. Take care. Stay cool. Bye now.